Options Made Simple, Part 3, How to Practice Trade Options. This is where the rubber hits the road. We have 9 simple beginning rules that you need to start with and you need to apply. We're going to go through them. This will set you off in the right direction from the beginning. First, you always buy to open. Always buy to open with a day order, not a good till canceled order. You want to use a day order. Why? Because you want to buy then. You want to buy at that time at the price at which you wish to purchase. We look at something like the Qs and say you decide that the Qs is going down. You are going to look at, for our example, the $199 strike price. Every dollar is a strike price in the Qs. Again, that represents a NASDAQ 100. It's an index ETF. And we look over here and we see the bid and the ask. Now remember, you always pay the higher price when you're purchasing. You sell for the lower price. It's only a 6-cent difference. Very liquid. Very liquid. Remember, liquidity is between the bid and the ask. And we see that it's $7.20. So you're going to enter a buy order. And again, that's buy to open. It's sell to close. So you buy to open at $7.20. Now, again, if you want to be assured if this thing's really moving, if the price throughout the day is really moving, and these option chains change constantly, the option chains change constantly throughout the day as price changes. So does the bid and the ask, just like with the underlying price itself. So if you want to be guaranteed to buy it when you want to buy it, maybe offer a penny or two more so that if there's a little bit price fluctuation, they're gonna give it to you at that whatever the price is when you buy it. So if it drops a couple of cents and you offer 122, they're gonna get you in at 718. I'm sorry, if you tried to buy it at 722, and get you in at whatever it is. And again, so make sure, however, again, following the rules, that you buy to open with a day order. Now, you always sell to close. You can sell to open, but that sends you in the direction of selling something you don't have. It can get a little confusing, so just remember the rules. Buy to open, sell to close. You only buy or sell with a limit order, never a market order. We don't ever use market orders for anything. That means the market maker gets to set the price. You don't do that. You always buy with a limit order. You always sell with a limit order. What does that mean? You enter the price you're willing to pay. You enter the price you're willing to sell. So again, always make sure it's a limit order, never a market order. Buy only liquid options. We've explained numerous times on the channel. I just did again what bid and ask are. That's the selling price, the buying price. As long as those are close, you have a liquid option. If they're far apart, if you see stocks that don't trade a lot or options in those stocks that don't trade a lot, it could be $3 between the bid and the ask. Now imagine that. You pay $12 for an option. Immediately after you buy it, it's worth $9. Hard for that to be a very good deal, something you want to stay away from. So only buy liquid options. How do you tell if they're liquid? There's a small difference between the bid and the ask. Don't have to go through anything else. How much of these traded throughout the day? If the difference between the bid and the ask is minor, then they're traded a lot. Okay, buy out in time. Recommend you start with 5 months out in time. Will it cost you more? Yes. But if you make a critically bad decision or something crazy happens with the market, and crazy things can happen. Remember 9/11? And all of a sudden, the bottom falls out and your option goes to zero. Well, at least you've got some time that it can recover. It may not. We're not telling you stay into a bad trade. We're talking about catastrophic things, giving yourself some time. So again, start with 5 months. And you can work that down or leave it at that as you get better at doing this, or really as you get more experience, because we want you to be good at doing this from the beginning. Why? Because you're going to be able to read stock charts. You're not going to jump into options until you can read stock charts. You're not going to start practice trading this stuff until you actually know what you're doing. And remember, the big caveat we've given in everything. The caveat is if you can't read stock charts and make successful practice trades using stocks and ETFs, you're not ready for options. Let's get back. Okay, you're going to start practicing in the money. In the money trades. And again, in the money is what? Well, when we start talking about in the money, it's the blue area on these charts. It tells us in the money, and we can see that when this option chain was run, the price was right at $309 of the S&P 500. That was its trading price. And we look at the option sheet and we can see the areas above price is where the call options are in the money. The area below price is where the put options are in the money. So we're going to buy in the money to start with. You're going to start practicing in the money. You're also going to set your loss limit from the beginning, but no stops. We're not going to let the market makers see your stops. You're going to go ahead and know what your loss limit is. You're going to pay attention a couple of times a day to how the option's doing. And if the underlying stock is not or ETF is not going in the direction up for calls, down for puts, then when you hit your loss limit, you are going to close the option. Take your small loss and move on. Remember, options can go to zero. Stocks rarely do that. But again, you're not paying as much for options as you are for stocks. But that is why they have risk, because that money can disappear. And again, we want your practice trades to be successful, because when they're not, you get downhearted. You think you don't know what you're doing. You lose your enthusiasm and you quit. Enter good till canceled sell order for some or all of the options at X percentage profit. Same kind of rules that you apply when you are buying and selling ETFs and stocks, when you're practice trading those. So go ahead and have your profits, your profit limits, what it is you're looking for, and whatever the system is you have set up to set your good till canceled sell order or orders selling some or all at set profit boundaries. And those are set any number of ways. That's a whole separate kind of training. But go ahead and set those and in your good till canceled sell order right after your day order is executed. Smart thing to do, because guess what happens? If indeed there is something great that occurs and you were Johnny on it and you've bought a call and it goes up, boom, the next morning, right as the day starts off, and maybe later in the day, it goes away. Maybe it even goes in the opposite direction. If you had your good till canceled sell order in and it hits that number, it sells it, your profit's in your practice trading account, and you're the man. Use trade worksheet without fail. Absolutely critical, my friends. Use that trade worksheet. Fill it out. Another thing I recommend you do as you practice trading options, print out the option chain for the time period that you are purchasing and also when you are selling in your practice trades. It's great to have those option sheets. They show you all sorts of fascinating things. You can actually look across the board and see how the in the money and out of the money we're doing if you print out those option sheets at the right time. I very much encourage you to do that. Now, another thing you need to understand, options are priced individually and sold in a block or contract controlling 100 shares. So if the asking price is $7 per option, you'll pay 700 virtual dollars for a contract to option 100 shares plus a commission, maybe, maybe not. So again, you'll see the prices. They're printed on the option chain sheets. And as you go through the procedure, and again, I want you to practice trade these. If you've got a platform where you can do virtual trading, that is the best way to do it. You can virtually trade, you can practice, and you can start understanding. But again, one of the keys I want you to understand, something important for you to do, is do print out these option chains so you have those, keep them, and be able to see how the prices on these fluctuated throughout the course of your practice trades. It's going to be very, very important. Keep those rules in mind, my friends. They will help you so immensely. I wish I'd had those when I first started doing my practice trading with options. Very, very important to keep you straight and out of trouble. The bottom line, options are easy, but only if you can accurately chart. That is the key. That is why we are chartingwealth.com. Charting is what it's all about. Once you can do that, everything else comes easy. We love to hear from you. Write us cw@chartingwealth.com. You want to support what we do here? A lot of great benefits for our Patreon supporters. See the link in the show notes. Also buy our book, Charting Your Way to Wealth. We have another book coming out in the not too distant future, Optionable Wealth. We'll keep you posted on that. But buy Charting Your Way to Wealth first. It's a great introduction to what we do. God bless. All the best from the whole team at Charting Wealth World Headquarters.